Neil, track this for me. You think that the Fed could actually move potentially 4 times next year, and at the same time, you say don't call them hawkish. Why?
Well, because I think they're following the data. I mean, one of the interesting things about the December FOMC meeting is that, they revised up their expectations for growth, they revised down their expectations for unemployment, and they revised up their expectations for inflation. So what do you expect them to do? Obviously, they're going to signal more interest rate increases. So if you sort of plug all their revisions into a sort of standard kind of Taylor rule type model, they're not indicating they'd hike any more than that. So I don't really think what happened in December was about their so-called reaction function. That's what we got at the June meeting, not December. And I think that's one of the reasons why on the day itself, the market sort of took the news in stride. So I wouldn't characterize this as a hawkish Fed. I think this is a Fed that's had they not signaled what they did, they would look increasingly offsides relative to the data as it's coming in.
All right, well, this is a Fed that already has accelerated the pace of tapering. That looks set to end in March. Are we looking realistically at March liftoff?
I mean, I certainly think it's a live meeting. One of the reasons why they're accelerating the tapering is to make it a live meeting. And, then just think about what's going to happen between now and then. I think it's highly likely that we're going to come back in the new year and we're going to get a strong December jobs number. Point number one. Point number two, what's going to change on the inflation picture between now and then? We're being told by the usual suspects to keep waiting for this moderation in goods prices. It's like waiting for Godot. I mean, if you look at wholesale prices for used cars, they're still rising at a meaningful rate. And so we're not going to see a moderation in goods prices. Meanwhile, housing inventories have been pared back to the bone. I mean, when you think they can't go any lower, they do. People are buying homes at strong prices. That's going to continue to keep the pressure on rental inflation. So, I think when you put these things together, you have strong jobs. We know that initial jobless claims are declining. We know that job openings are strong. To me, that sort of is presaging another decline in the jobless rate. So I think we're going to be back in March, and the Fed's going to be revising down their expectation for unemployment potentially, revising up growth, and maybe even taking their inflation estimate up a little bit. But I think, the data as it's going to come in over the first quarter will probably lead them to hike. And Powell was pretty clear. He doesn't seem that he's not signaling much discomfort with the limited space between the end of the tapering program and the first hike. I think markets will be okay with it because it's about the data, right? I mean, if you're in an accelerating nominal growth environment or a strong nominal growth environment, that's an environment where companies that trade on the S&P 500 can make profits, and that's ultimately what matters.
Clearly, there's very strong demand for stuffed toys. Inventories are being built in a fairly significant way in the Dutta household.
Yeah, I mean, between PJ Masks this year is the big one.
And for the benefit of our radio audience, Neil has canceled the bookshelf work from home shot. Instead, he is surrounded by a pile of stuffed animals, including what looks like a rather large minion from Despicable Me guy.
Someone on Wall Street had to take a stand against the standard bookshelf background with, littered with books that, let's be honest, none of us have ever actually read. So
no. Normally I work my way across. Neil, normally I work my way across people's bookshelves and try and read into kind of what they think is behind them. I'm trying to do the same here. I got a Minnie Mouse. I got a pretty big minion. I think there's a troll in there somewhere as well. It's a good selection you got going on. Neil, you talk about the sequencing and what the market's afraid of. At the moment, the market is apparently unafraid of a faster taper. It is unafraid of rate hikes. What about a rolling off of the balance sheet? What about QT? Where does that come, and is that what you think will really spook investors?
I think that's a great question. And if you go back to the most recent historical analog guy, it's 2018, right? I mean, the Fed was hiking, and the balance sheet was contracting. And 2018, that year, I believe, I mean, Gina can correct me if I'm wrong, I think the S&P 500 fell, I think, about 6 to 7% over the year. But if you go back to that period, what was really the driver of that weakness in equities? Was it the Fed? Or was it the fact that the former president was prosecuting a trade war? Most of the big declines in the equity markets in 2018 didn't happen on days of new Fed information. It happened on days of trade tweets, pressing the heat on the Chinese. The broader economy was fine. So you had a tailwind from the economy and earnings that year. You had a slight headwind from the Fed, but really the weakness in equities that year, I think, was driven by the trade war. So unless President Biden wants to prosecute, increasing trade tensions with China, I think the markets will deal with it. And also, 2022 is probably going to be a year of synchronized global economic activity as we all exit the pandemic together. One of the interesting data points that I've noticed lately, and you can take a look at our Twitter, is that mobility out of emerging Asia, Korea, Thailand, Indonesia, India, it's up and to the right, which suggests that they're getting on with it. And that to me suggests that we're going to turn the corner on this supply chain issue.
Neil, I'm glad you gave me the window to talk about 2018, because I think the one part of 2018 that's really missing from the discussion is the fact that that was a year of margin compression on the S&P 500, perpetuated not only by the trade war, but also by a necessity for spending by some of the big cap tech stocks in the name of Facebook and Google, really starting to spend more on internet security software and the like, compressing margins for the index at large, which then led to the correction, in my view. So when you talk about 2022 and you talk about maybe some of this margin risk clearing in 2022, what's the mechanism by which you expect that margin risk to clear? Because I think we're starting to see the reality come to the forefront that supply chains are still somewhat constrained, and many people are saying that's not going to clear until 2023 at the earliest. Is there something else that you can see that creates a pathway for margin expansion to resume into the year ahead, which will really certainly power a much more optimistic outlook for the index?
Well, I think for the industrial sector, it's hard to argue that the supply chain issue won't improve, right? So at some level, that'll probably boost at least industrial sector margins. I mean, I don't think they're going to be passing that on to consumers. Right. So I think that's the first point. And then secondly, I mean, I think productivity is like to pick up somewhat as well. I mean, remember, we've been investing a lot as it is. We're getting used to these new working arrangements. Mm-hmm. So we'll probably see some rebound in productivity over the next year as well.
And speaking to that productivity rebound, how do you see labor costs playing into the overall environment? There is some concern that maybe labor costs will become more deeply embedded, resulting in upward inflation pressure at large over the course of this cycle. Is that not something that you see as a risk to the outlook?
I mean, I think it's absolutely a risk, but I guess the issue is what's going to happen with, so right now, obviously, you have a lot of people quitting their jobs. They're chasing wages higher, particularly in certain industries like leisure and hospitality and retail. It's certainly not economy-wide. But I do think that as we exit the pandemic, you should begin to see more labor supply being freed up. And that may reduce the appetite for those that are currently quitting their jobs to keep doing so, right? And so as that happens, that should mitigate some of the pressure in wages, which in turn should mitigate some of the pressure in unit labor costs that certain companies are seeing. Certainly, I would argue it's not economy-wide. I mean, but you are seeing it. It's hard to deny what we see in, at the restaurant, in the restaurant industry, at the retail industry. But yeah. But I do think as labor supply gets released, those that are tempted to currently quit their jobs in search of a new one will be less tempted to do so.
Hey, Neil, this might be unfair. We have 30 seconds left and a viewer question coming through on IB. Why are not longer interest rates higher due to higher inflation?
No, that's a great question. I mean, I think the long end of the Treasury market, I mean, it's sort of we need to see it to believe it. So, remember back in 2016 to 2018, we were dealing with a lot of these questions. But as the Fed was hiking, you saw the long end ultimately back up, again, in an environment of strengthening U.S. and global economic growth.
Yeah.
But I also think part of this is also a function of what's going on across commercial banks who have been gobbling up Treasury securities at a appreciable pace.